Well, good morning again. Sorry for the technical difficulties. We'll start anew. Welcome to the May 19th meeting of HOC's Budget, Finance, and Audit Committee. I'm Rick Nelson, Chair. To my right is Jeffrey Markowitz, Commissioner, and remote is Fran Kelleher, another Commissioner, member of the committee. And we're joined by the Executive Director of HOC, Chelsea Andrews, and other staff. The first item on the agenda for today's meeting is the approval of the minutes of May 12th. Do I hear a motion for approval?
So moved.
I second.
All in favor?
Aye.
Aye.
They are approved. The first item for discussion is the fiscal year 2023 third quarter budget to actual statements. And to begin the presentation, I'll turn it over to the Executive Director, Chelsea Andrews.
Thank you, Mr. Chair, Commissioners, members of the public, and the HOC team. Our finance team will lead us through our different agenda items today. We'll start with the third quarter budget to actuals. You will hear that there will be a report out of positive movement, but there still continues to remain outstanding challenges that we're working through as it pertains to rent collection and timing of our various real estate development projects that are impacting our budget, but overall our position remains healthy. And I will turn it over to Tim Getzinger, our acting CFO, as well as Terry Fowler, our budget officer, to provide the presentation. Thank you.
Thank you, Executive Director Andrews. Thank you, Commissioners. Before we delve into the discussion and action items, I'd like to provide a brief snapshot of where we are in quarter 3 FY23. HOC's finance team provides quarterly reporting on key financial metrics such as liquidity ratios, reserves, and fund balances. We report on a variety of topics, including budgets to actuals, budget amendments, a review of uncollectible tenant accounts, and overall agency financial position. We also monitor macroeconomic factors, including interest rates and inflation, to better understand the ever-changing financial landscape. Today, the finance team will be presenting on the third quarter performance, as well as providing information on calendar year property audits, and I'll cut to the short on that item. They're all clean. And 2 budget amendments. There's also an item from property management. Detailed performance data is available in the package provided earlier this week, and this morning staff will be presenting highlights of property and agency performance. The following is a summary of the financial position for the agency. Cautious optimism is the word. Although there are fluctuations in certain areas, HOC's financial health remains positive and stable. The Commission's net position decreased by 1.9% in the first 9 months of FY23. However, this is an improvement of $2.9 million quarter over quarter. Staff will provide details on these modest changes during the discussions of the unaudited financials. Key liquidity ratios, including quick and current ratios, remain strong and are up from the end of the fiscal year, as well as quarter over quarter. Finally, the cash ratio is down from the end of the last fiscal year. However, it has improved each of the last 3 quarters and is well within a healthy range. Reserves, including the general fund operating and property reserves, are both healthy and are above last year's levels. A review of our 9 revolving development funds, and we are adding in the Housing Production Fund as a new source this quarter. We've had it for a little while. We examine the current year performance of these development funds and project 2 years of activity, and these funds all demonstrate stability. As mentioned last quarter, we are applying rental assistance resources to cover a sizable portion of our rental arrearages. $2.1 million was applied in the third quarter, with additional resources available to be applied. However, and I said this last quarter, we need tenants to pay rent. A large driver in Q4 FY23 performance will be the timing of commitment and development fees, as well as property performance, specifically deferred maintenance, utility cost, and rent collection. You'll hear this theme shortly during the presentation of the budgets to actuals. Looking ahead, the Executive Director's FY24 recommended budget will be presented for approval on June 14th. And it forecasts strong commitment and development fees as well as increased rental receipts due to the recently promulgated 5.8% voluntary rent guideline and an increasing utilization of housing assistance payments, which is over 96.5% currently. These factors, as well as continuing to enhance property performance, will help boost overall agency performance. If there are any questions regarding this, be happy to address them.
Let me first say thank you for the overview. This is an added piece to the presentation by the finance department. I think it's something that's very useful for me, and I believe for other commissioners. So I appreciate that. I don't have any questions in terms of the overall. Are there any questions from either Fran or Jeffrey before we get to the detailed presentations? Fran, we can't hear you. You're on mute, I think.
I just want to echo your appreciation of the executive summary overview. That is very helpful. Thank you.
Good. Okay, then
Well,
we'll dive into the details.
very welcome. The first discussion / action item for today will be the fiscal year 2023 third quarter budget to actual statements, which will be presented by Terry Fowler, our budget officer.
Thank you, Tim. Good morning, Commissioners, Executive Director Andrews, staff, and the viewing public. For the record, I am Terry Fowler, the budget officer. And as Tim mentioned, I will be discussing the third quarter budget to actual statements for fiscal 23. If we move to page 16 of the packet, the agency ended the quarter with a net cash flow surplus of approximately $239,000. This resulted in a third quarter budget to actual negative variance of $1.2 million when compared to the anticipated third quarter net cash flow surplus of $1.4 million approximately. The primary causes were lower unrestricted cash flow in some of the unrestricted opportunity housing properties as a result of property performance, coupled with lower income in the general fund. And these were partially offset by savings in various expense categories in the general fund. As Tim mentioned, it is worth noting that as a result of the applied rental assistance, the bad debt expense that was $2.7 million at the end of December and carried a $1.3 million negative variance at the end of the third quarter, that bad debt was reduced by $300,000 net. And that resulted in a negative variance of approximately $567,000, or less than half of the variance experienced as December. We have applied additional rental assistance of approximately $435,000 in the month of May and are continuing to apply the balance of the rental assistance. As that is applied against the rent arrearages and the allowances for bad debt at the properties are adjusted, we do project that there'll be a continued positive income on that impact on that expense. Continuing on page 16 to the general fund, this fund ended the quarter with a deficit of just under $6 million, which resulted in a positive variance of approximately $811,000 when compared to the projected deficit of $6.8 million. Income in the general fund was $3.1 million less than budget, and this is primarily due to the result of delays in the receipt of commitment and development fees for various projects. These fees have shifted into our FY24 timeframe and will be included in the proposed FY24 budget presented to the Commission at the June 14 meeting. We do still anticipate a development fee in the fourth quarter from residences on the lane that originally was budgeted to be received in December. In addition, we do have lower draws from the Opportunity Housing Reserve Fund, or OHRF, for real estate personnel and pre-development costs. This lower income was partially offset by the receipt of Federal Emergency Management Agency, or FEMA, reimbursements of approximately $680,000 for COVID-19 related expenses. A portion of that income will be transferred to the properties that incurred the reimbursable expenses. The positive expense variance in the general fund is primarily the result of salary lapse and benefits, coupled with savings in various expense categories. And it is worth noting that some of this is a result of timing, and we do not anticipate that full savings at year end. For our bond funds, we do have positive expense variances in both funds due to lapse in salary and benefits, coupled with savings in financial services and legal expenses. If we move on to page 17 of the packet, this chart is broken into two pieces: unrestricted and restricted development corporation properties. The properties with unrestricted net cash flow generated cash flow of $4.39 million, which is just over $1 million lower than projected. In our review, we have determined that the variance is often largely attributable to items such as higher maintenance, bad debt, and utility costs, coupled with lower tenant income due to the rents and vacancies. The second group of properties with restricted net cash flow generated negative cash flow of approximately $550,000, which is $146,000 greater than the projected shortfall. And this is primarily due to the RAD 6 properties, which had increased bad debt and maintenance and higher vacancy. If we move on to page 18 of your packet, these again are broken into two groups: properties with unrestricted cash flow and properties with restricted cash flow. The first group generated cash flow of approximately $1.84 million, which is $944,000 lower than projected. And the variance is caused by the same categories as was reported in the development corporation. The restricted group has $803,000 lower income than budget. If there are any questions, I'd be happy to address them before we move on.
Yeah, you mentioned vacancy loss, and I noticed in the memo, a number of properties referencing that. And I don't know, it's hard to tell from the memo, like how significant that is, and just that there were a number of them. I was wondering, is there anything going on in the market, or what's leading to that?
I would defer to property management, who is in the room, to address the questions on vacancy.
Right. And while Alex comes up, one thing that I would just indicate is that we have looked closely at this as well. One of the things that we're going to deploy is ensuring that each of our third-party property management companies properly reflect what is true vacancy loss versus what is a unit that's occupied in which we haven't received income for a very long period of time. There are different approaches that different property managers have taken in terms of where they would categorize that loss. And so we are taking a closer look at that as well. But I'll allow Alex to also provide any additional context related to vacancy loss.
Good morning, and for the record, Alex Torton, asset manager with HOC. As Chelsea stated, that is very true. We also, for a lot of our properties that use wait lists that have been in place for a long period of time, we've seen that it is taking more and more calls to fill units than it has in the past, as we've called on these same wait lists for a number of years. And that's made a big impact on occupancy as well.
Does that mean the wait lists are stale?
It appears so in some cases, yes.
Okay. And how often do we do a refresh on those?
I couldn't speak to the last time that we've done, a refresh or say a purge of a wait list.
But you're talking about individual property wait lists, not the
Integrated wait list.
That's correct.
I have to say, I'm always confused about having the individual property wait list and the relationship they have to the larger wait list that we have. How do those two get interfaced? Or do you know?
And actually, interestingly enough, on Monday, we will be having a full discussion about the wait list because we are in the process of migrating, and we'll be doing that over the summer. So we will be giving significant detail in terms of how our current system operates and the proposed system that we'll be moving to, which will be Yardi here this summer. But HUD does require us to have a property-specific waiting list. I think that I'm not certain if either Ellen or Darcel are in the room or online virtually. They have more subject matter expertise in terms of our requirements to go down the property waiting list before you go to the full waiting list. But I assume there is a sequence there. We could get more information and supplement for you as well. But I do know that each of the properties have different requirements in terms of income, in terms of eligibility. And I also know that there are circumstances in which when you apply for the waiting list and where you are at the time we're calling you, there may be a difference in your circumstance. And so determining eligibility, going down the waiting list, calling multiple people to try to confirm that you still meet the eligibility criteria is definitely a very high intense administrative exercise. And so we are exploring how to ensure that, number one, we refresh that information and we make it easier for our customers to apply for and or opt in or out properties that they meet the eligibility criteria for.
Chelsea, I am here. You didn't come.
The other piece that relates to this, and I don't know how it factors in. A couple years ago, we instituted the practice of holding the third-party managers accountable for the amount of vacancies, and their compensation was based on percentage of vacancies or occupancy. How is that factored in or not factored in? I mean, one would think that they would be encouraged to overcome some of these obstacles. Mm-hmm. Are they not able to? Are they complaining? And what's the situation?
I would say that, as you all know, that particular division has had some transitions in leadership that has impacted our ability to have the level of oversight that we need to have in terms of our properties. However, we've brought in and developed a new asset management division. We are working to enforce our contracts in many ways, and we're still recruiting for our director of property management. But our third-party property managers are aware of our expectations, and we have deployed our director of asset management to provide that level of oversight that was in transition for the last 6, 7, 8 months maybe. And so there is an expectation that vacancy as well as rent collection would directly impact compensation for each of the companies. However, in the midst of the transition post-COVID, one of the things that we are hearing is a heightened level of desire that we move swiftly on evictions. Mm-hmm. And our decision to ensure that we got our funding out the door first for tenants is something that has kept them in a limbo status in terms of how to move forward as quickly as they can to turn those units and bring in tenants that are able to pay rent. And so one of the things that we're moving forward with here, as we've already discussed, was to move forward with eviction. But right when we were ready to do that, we got an extension of additional time to use CDBG funds. It extended until September. And so we don't want to be premature with eviction activity, but that is one of the areas that our third-party property managers wishes that we would be a little bit more expedient about. And so that's the feedback that we receive from our property managers. As you also know, and I'll just remind the committee as well as just state for the public, we are also transitioning all of our third-party property managers to the same system, to Yardi. As it stands, some of them have their own systems, so there's lags that can occur with reporting for us to even be able to know what the current status is. And so we are working to transition all of them. Our IT system division has been working closely with each of our third-party property managers, and all of our RFPs for the next round of contract will require that you utilize Yardi. That will allow us to even have a much closer eye on the day-to-day impact of each of our assets and how they're faring.
I'm glad that we're exhausting every opportunity to, we're not evicting tenants without exhausting every opportunity to either give them a chance to pay the rent or to find other sources. But is that the source of the tension or with the property managers of sort of mislabeling vacant versus
Good morning. For the record, I'm Kayreen Brown, Deputy Executive Director. And just to add to what you've already heard and to put a finer point on the vacancy number that is being reported, you may have heard us report or speak to you about economic vacancy. And that goes directly to what Executive Director Chelsea Andrews has just said about our delay in starting lease enforcement or eviction actions. And so the management companies they're rolling all actual vacancy into along with not paying rent category. And so we're seeing vacancy as one big category as if units are empty. They're not really empty, but it reflects the rents that's not being collected. And to your point about Commissioner Nelson about adjusting management fees to reflect that, we've taken the position at this time that until we've exhausted the rental assistance and applied them, we've not started actual evictions. And so we're not penalizing the management companies for failure to collect at this time because they are, they're ready to start evicting folks so that we can have paying tenants. So it's a combination of factors. The market in general isn't soft. It's a pretty strong rental market, and so HOC's properties should be seeing pretty high vacancy, especially given the way we raise rents and things of that nature. And so once we clear through some of the issues with arrearages, I think you'll see that number starting to look a little different, and especially because we plan to separate the two categories. So you'll see the true vacancy, which are the units that are not occupied, from anything that is economic vacancy. And so we'll be working through those issues over the next several months.
And likewise, glad to hear the work that's being done on the wait list. I think, anything we can do to speed that up. I mean, not just for our own benefit of income, but to get folks off the wait list and housed where they want to be housed.
Mm-hmm. Yes.
So. Thanks, Alex.
Thank you.
Any follow-up question for you, Fran?
So thank you. I appreciate the discussion, and I am just beginning the review of the briefing materials for the administrative meeting on Monday, which is all about the waiting list. So you guys may want to look at those too when you have a chance.
Okay, thank you. That concludes those questions. Move on. Pardon.
If we can move to page 19 of the package, this is the federal programs. The voucher program, overall, there was a surplus of approximately $881,000. This was comprised of an administrative surplus of $1.5 million, countered by housing assistance payments that exceeded the housing assistance payment revenue by approximately $632,000. Shortfall will be covered by a draw from the Housing Choice Voucher Reserve, known as the net restricted position. The administrative surplus was the result of higher than anticipated administrative fee income, coupled with savings in administrative expenses due largely to staff turnover. It is worth noting that the administrative fee income surplus was primarily the result of higher proration factors that was changed from 88% to 89.2%, and more recently increased to 89.5%, coupled with the increased utilization in the program and fees received to support the emergency housing vouchers. Moving to page 20 of our packet, we are presenting the capital budgets, and some of the properties have exceeded their annual capital budget because of unplanned capital work. The majority of these properties have sufficient property reserves to cover the overages. Where this is not the case, staff are reviewing the obligations from the Opportunity Housing Property Reserve to ensure sufficient funds are available to cover the balance of the overages. This concludes the presentation, and I would be happy to address any additional questions you may have at this time.
Thank you. No, I think we've asked all the questions that we had. Thank you for the presentation.
Thank you.
There's no action required on this particular item, so we will now move to the next item, which is the third quarter unaudited financial statement.
Thank you. This next item will be presented by Francisco Vega, the Assistant Controller for HOC. Francisco.
Good morning, Commissioners.
Morning.
For the record, I am Francisco Vega, Assistant Controller. If we can scroll to page 22 on the packet. Thank you. The Commissioner's net position decreased 5.6 million or 1.9%, primarily due to net operating loss driven by lower development fee income and higher interest rates. The liquidity ratios improved primarily due to a decrease in the multifamily bond fund undrawn proceeds payable due to additional bond draws for HOC at Westside Shady Grove, HOC at Stewarttown, Bowell Park Apartments, HOC at Georgian Court, HOC at Shady Grove, and HOC at Willow Manor. In March of 2023, the current ratio was 4.23 as compared with 2.68 in June of 2022. The quick ratio also increased from 2.5 in June 2022 compared to 3.83 in March of 2023. The total assets, excluding the deferred outflows, decreased by 36 million or 1.8% from 2 billion in FY22 to 1.9 billion in FY23. The decrease is largely due to a decrease in restricted and unrestricted cash, cash equivalents, and investments, and net capital assets, partially offset by an increase in mortgage and construction loans receivable. The decrease in cash and restricted cash and cash equivalents is mainly due to additional draws from the undrawn bonds proceeds within the multifamily bond fund for several real estate developments under construction, as well as a decrease in cash for the single family bond fund current bonds payable. The decrease in unrestricted cash and cash equivalents is mainly attributed to a decrease in the general fund due to the payments of the FY23 commercial liability insurance, property taxes, and annual Yardi license and maintenance for Yardi SaaS private cloud system, a decrease in the OHRF, and an increase in advances to several component units due to timing. The decrease in the OHRF is largely due to bridge financing of HOC at Shady Grove and Hillendale Gateway, pre-development expenses, and funding at HOC at LLC multifamily member equity contributions. The decrease is partially reduced by an increase in unrestricted cash at the property level, primarily to the Metropolitan, Westwood Tower, Riley Crossing, Paddington Square Development, Pooks Hill Development, HOC at Battery Lane, and Timberlawn. The decrease in net capital assets of 10 million is primarily attributed to the normal depreciation of fixed assets. The overall net increase of 53.6 million in total mortgage and construction loans receivable is due to additional P&C real estate line of credit draws for Elizabeth House 3, HOC at Upton 2, HOC at Willow Manor, HOC at Stewarttown, HOC at Shady Grove, Hillendale Gateway, and the Wheaton Gateway development. The total liabilities decreased largely due to bond draws for HOC at Westside Shady Grove, HOC at Stewarttown, Bauer Park, HOC at Georgian Court, HOC at Shady Grove, and Willow Manor. The multifamily bond fund redeemed bonds for 9.1 million under the multifamily housing bonds development 96 indenture, the 0.6 million under the standalone 98 issuance, bond defeasance related to the 94 Strathmore issue for 0.5 million was also retired. The single family bond fund redeemed and retired bonds for 18 million under the 79 indenture, 4.9 million under the 2019 indenture, and 2.5 million under the 2009 indenture. If we can scroll to page 24 on the packet. Thank you. The commission has a net loss of 5.6 million as of the third quarter ending March 31st, 2023, compared to a net income of 64.5 million for the same period last year. However, after adjusting the net income for the recording of capital contribution, unrealized loss on investments, and gain on sale of assets, HOC ended the fiscal period with a net loss of 258,801 as compared to a net income of 4.2 million for the same period last fiscal year. If we can scroll down just a tad bit. Thank you. The overall net decrease of 4.5 million in the adjusted net loss is largely driven by an increase in HAP expense due to an increase in leasing and leasing cost, an increase in total interest expense due to interest on the Battery Lane acquisition loan with Eagle Bank, accrued interest on MV Gateway, LLC mezzanine loan, and Bradley Crossings Eagle Bank loan. The single family and multifamily bond funds also contributed due to bond issuance. A decrease in other income, net of other expense, due to a decrease in development fee income. This is partially offset by an increase in HAP income due to increase in HCV main program, emergency housing vouchers, HCV incoming portables, mainstream program, incremental housing choice vouchers. An increase in investment income is largely due to investments of the remaining bond proceeds. An increase in interest on mortgage and construction loans receivable is mainly due to an increase in the MHDB 2021 series CD mortgage loan receivables balance in the multifamily bond fund. A decrease in maintenance expense due to general fund and public funds computer equipment and computer software expenses related to application development and technical services. A decrease in utilities at Barclay One Associates, Paddington Square, Saddle Apartments, and the sale of 3 manor properties, Shady Grove and Georgian Court. A decrease in fringe benefits driven by Opportunity Housing Fund contracted management benefits for third-party managed properties, as well as a decrease in the general fund healthcare services, retired employee benefits, and health insurance. If we can scroll to page 26. Of the it's adjusted operating revenue. Great, thank you very much. Similarly, when revenues from operations for FY 2023 and FY 2022 are adjusted for HAP income and unrealized loss investments, the adjusted operating revenues decreased by 985,454, largely due to a decrease in management fees and other income, county grants, and dwelling rent. When the operating expenses for FY 23 and FY 2022 are adjusted for HAP expense, the adjusted operating expenses increased by 2.6 million from 118.6 million in FY 22 to 122 million in FY 23, primarily driven by interest expense and administrative expense. If we can scroll to page 27. The non-operating net revenues totaled 3.8 million for the fiscal period ending March 31st, 2023, as compared to the net income of 3.2 million for the same period last year. This is attributed to an increase in operating interest on mortgage and construction loans receivable, investment income, and other grants, partially offset by an increase in operating interest expense. This concludes the financial statement presentation. If you have any questions, we'll be happy to answer them, commissioners. Thank you for your time.
Do you have any, pardon me, do you have any questions, Fran or Jeffrey? Thank you, Francisco. The next item on the agenda is.
Before you move on to item 3, I think we needed a vote on item 1.
We did?
Yes, to the commission.
Sorry about that. What page? We have to, I'm sorry, what the action is to refer it for acceptance by the commission?
Yes.
All right, I apologize. Is there a motion, is there a resolution there or?
I move that we.
Okay,
I move that we join the staff's recommendation to forward or to accept the third quarter FY 23 budget to actual statements.
Is there a second? Is there a second? Fran?
Second?
All in favor, say
Yes.
Aye.
Aye.
Aye, then the motion is approved. Sorry about that. Next item, there was no action required on the financial statements, correct?
No.
All right. The next item is the uncollectible tenant accounts receivable.
Thank you. This item will be presented by Neely Rizigi, our accounting manager.
Good morning, commissioners and everyone. My name is Nilu Rizegi, accounting manager. The agency's current policy is to provide for an allowance for any tenant's accounts receivable balance, which are older than 90 days. On a quarterly basis, the staff also recommends to the commission the write-off uncollected receivable from past tenants. The proposed write-off for the third quarter of fiscal year 2023 amounted to $76,000, an increase of $27,000 compared to the previous quarter. This period's write-off consists of $54,000 of bad debt from Opportunity Housing, $11,000 from supportive housing properties, and $11,000 from the lab properties. The primary reasons for the write-off across the property include tenants who passed away, left due to a job transfer, needed more space, purchased a home, skipped, voluntarily vacate their units, and transferred to a different program. After the full commission's approval, the write-off is proposed through Yardy's write-off function with the tenant detail placed into the uncollectible accounts receivable database. The next anticipated write-off will be for the fourth quarter of fiscal year 23, which will cover April 1st to June 2023. If you have any question, we'll be happy to answer them. Thank you.
Are there any questions? Then I'll entertain a motion to join the staff's recommendation to forward this to the commission for.
Just one quick question, I guess, and I'm sure we've probably had this discussion before, but so when a tenant transfers to a different program, is that a different HOC program?
Yes.
Yes.
Yeah, and so, but they're skipping out on their rent, but they're continuing in HOC under a different program?
That is
For perspective, I believe there's only an $11 difference in that category. So it will be worked out, I'm sure.
Okay. If Fran doesn't have any
I
questions.
move that we join the staff.
You were cut off, so I well.
I will move that we join the staff in forwarding to the commission staff's.
Well,
I assume she means staff's recommendation
yes,
to.
okay, we
write off the
we're gonna say the
unclaimable
staff recommendation
accounts,
to.
and I will second.
Authorizing the write-off.
Yeah.
Jeff seconds that that motion. All in favor, say aye.
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 Then it is approved. The next item on the agenda is the calendar year 2022 audits for low-income housing tax credit partnerships.
Thank you, Commissioner Nelson. This next item will be presented by Claudia Wilson, our accounting manager.
Thank you, Tim. Good morning, commissioners,
Morning.
executive director, staff, members of the public. For the records, my name is Claudia Wilson, accounting manager. This presentation is for the calendar year 2022 low-income housing tax credit partnership and limited liability company audits. The Housing Opportunities Commission of Montgomery County, HOC or commission, is the managing partner in 17 low-income tax credit LIHTC partnerships, which operate on a calendar year basis, requiring the preparation of audited financial statements for the period ending December 31st, 2022. 16 of the 17 LIHTC entities require the preparation of year-end audits for calendar year 2022. One entity, Elizabeth House 3, is currently under construction and does not yet require an audit. HOC also has 4 calendar year limited liability company properties, CCL Multifamily LLC, also known as the Lindley, Hillendale Gateway LLC, Wheaton Gateway LLC, and HOC at Westside Shady Grove LLC. The calendar year 2022 audits of CCL Multifamily LLC and HOC at Westside Shady Grove LLC are presented in this request. Hillendale Gateway LLC and Wheaton Gateway LLC are in pre-development phases and do not require an audit for the year 2022. The property audits of 12 calendar year 2022 tax credit partnership, CCL Multifamily LLC and HOC at Westside Shady Grove LLC have been finalized and have received a standard unqualified audit opinion from independent certified public accounting firms performing the audits. The audits of 4 LIHTC partnership, 900 Fair Limited Partnership, HOC at Stroton Homes LLC, HOC at Bellow Manor LLC, and Spring Garden 1 Associate LP are yet to be finalized and are awaiting investor approval of the final drafts. The final audits of these properties, all of which are expected to receive a standard unqualified audit opinion, will be added to the commission packet for acceptance on June 14th, 2023. Does the Budget, Finance, and Audit Committee wish to join staff's recommendation to the Commission to accept the 12 calendar year 2022 tax credit partnership, CCL Multifamily LLC, and HOC at Westside Shady Grove LLC audits? Staff recommends that the Budget, Finance, and Audit Committee join staff in its recommendation to the full Commission to accept the 12 calendar year 2022 tax credit partnership, CCL Multifamily LLC, and HOC at Westside Shady Grove LLC audits. This is the conclusion of my presentation. Thank you.
Thank you. Any questions?
I would move that we.
Again, congratulations on the clean audits.
I was about to say that. Good.
I would move that we join the staff's recommendation to accept the 12 audits.
I second.
All in favor, say aye.
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 Motion is approved. Thank you.
Claudia.
The next item is a calendar year 2023 budget amendment for the Leggett.
Thank you, Commissioner Nelson. The next two items are both budget amendments. The first item will be the Elizabeth House 3 LP budget amendment, and this will be presented by Terry Fowler, our budget officer. Welcome back, Terry.
Let me just ask a procedural question. On these properties where we've changed the name, like the Leggett, why do we continue to refer to it as Elizabeth House 3?
It's probably legal name.
It's the legal name of the entities.
Do those get
Is
changed?
there a serious problem in terms of changing the legal name? I mean, it seems to me to continue to go on in referring to these with two different names as
It would be a lot of administrative work to change the legal name because of all the documents that are in that owner's name. So for instance, at H3, some of the construction contracts are still in play. And so that's in the legal entity's name. So if we change the entity's name, it'd be a lot of work.
so.
And often we do not refer to the property by its owner's name. In this situation, it makes sense because you're talking about a budget amendment and you're talking about the entity, but it's really just, you know, in the background and on day to day, you would not be referring to the owner's name.
But, you know, we have other properties like that, like the Fenton, I think, is legal name is Thayer, right?
It's 900 Thayer.
So when we refer to it, we refer to it as Fenton. We don't refer to it as Thayer.
We do not refer to it as Fenton Silver Spring, but when the commission has to take official action with regard to the entity such as the budget or the audit or something else, then we need to revert to the official legal name of record.
Well, it just seems to me that maybe in the final resolution that we have for the commission, we ought to refer to the proper legal name. But in the memo supporting it, I think we can get away with just referring to the popular name. I mean, part of the reason for it is that at some point it gets confusing for people who might be looking at some of this stuff when they're not sure what these names are.
Sure, for memo purposes, we can go forward.
So I think we ought to think about that as a process to refer to it as the name that we've given the property, but in the legal documentation, we can refer to it with the legal name. Okay, sorry for that interruption. Fair enough.
Good morning again. I'm Terry Fowler, the Budget Office. In 2020, HOC began construction of the Leggett, which consists of 267 senior units. The substantial completion date was March 7th of 2023, and occupancy began earlier this week. This requested budget amendment incorporates a budget for the period of January 1 through December 31, 2023. The table on page 81 summarizes the proposed budget for calendar 23. Rents are largely unchanged from those used in the original underwriting, and the budget assumes that the property will achieve a combined physical occupancy above 90% by December 2023, based on the early lease up of the affordable units. Expense numbers are based on in-place maintenance contracts and staff salaries, as well as assumed first-year expenses in the pro forma. The property is projecting cash flow of approximately $619,000 that will be restricted. If you have any questions, I'd be happy to address them.
Are there any questions? Then I'll entertain a motion to join the staff's recommendation to forward this to the commission for approval.
So moved.
Seconded?
All in favor?
Aye.
Aye.
Then the motion is approved. The next item is the calendar 23 West Side Shady Grove budget amendment.
Thank you again. For the record, Terry Fowler, Budget Officer. In fiscal 21, HOC broke ground on construction of the Laureate. The project delivers 268 highly amenitized mixed income units, steps from the Shady Grove Metro. Construction is complete and occupancy began the week of April 10, 2023. This requested budget amendment incorporates a budget for the period of January 1 through December 31, 2023. It is worth noting that the customer service center that will be incorporated into the building is part of the agency fiscal 24 budget that will be presented on June 14th and is not included in the operational cost of the Laureate. The table on page 84 of your packet summarizes the budget for this property, and rents are based on the approved rent schedule from the latest development pro forma, which have increased slightly since the initial rent study based on changes in the market. The affordable rents are based on moderately priced dwelling unit or MPDU and workforce housing rates established by Montgomery County for the respective AMI limits. The budget assumes that the property will achieve physical occupancy of 65% and 73% for market and affordable units respectively by the end of the calendar year. Expenses are based on the in-place maintenance contracts and staff salaries, as well as the assumed first-year expenses in the pro forma. Due to the lease-up occurring during calendar 23, the property is projected to have an operating deficit of approximately $173,000 that will be covered by funds established in an operating deficit reserve of the development budget. And I'd be happy to address any questions you may have.
So, quick question is the vacancy loss there primarily the retail space or the tenant space?
The occupancy referred to here is the tenant vacancy.
Okay. And is this taking, did we start later with, starting to occupy this than say with the Leggett, or is this taking longer to fill up?
If we could have property management address the lease up questions.
Yeah.
Good morning again. So the Leggett has actually started later than the Laureate as far as applying and leasing has gone, yes.
Mm-hmm.
You do see
the Leggett started later, but it is filling up quicker.
It's expected to fill up quicker once it gets started. They do have obviously the 49 units from the current Elizabeth House that will be taking immediate occupancy. They've also, during their delays, have had a lot of time to call and proactively fill. So they've taken They're up to 216 pending applications that they've already taken. So they've seen a phenomenal success rate. The Laureate has also seen pretty strong velocity, just not at the same level as the Leggett.
So, thank you.
Yep, of course.
I guess on that, because when I was looking at this, I didn't understand. You're expecting a vacancy loss of 3.5 million in 23.
We'll have Zach Marks, our Chief Real Estate Officer, give a little bit more context because it's a new development in the way that vacancy is reflected in this budget there's a nuance point here. And so I'll allow Zach Marks to provide more context.
Yeah, and for the record, Zachary Marks, Chief Real Estate Officer, and just want to make sure that my description is compatible with the work that Tim Terry and the team have done. But the general idea here is that there is a gross potential rent for the property. Obviously, the property's been open for a few months, so that gross potential rent will be achieved, but it's obviously not going to be achieved as soon as it's open because it's a new construction project. It's in lease up. So technically, in looking at the building, that vacancy loss is really arrived at by saying the second the building's open, there is a gross potential rent of 5.9 or something like that. But based on the current projection of lease up, we anticipate that initial lease up to get us, a portion of revenue that around 2.4 million that gets us to the 3.5 of vacancy loss. But it's not as a result of the building underperforming, if that makes sense.
Yeah. I guess what doesn't totally make sense is when we budget the first year of a new property, why wouldn't we budget what we anticipate to be the lease up income for the year rather than total gross rent that we would receive if we were 100% occupied? I'm confused by that. I mean, we know that the first year of occupancy of a new property is not going to end up with 100%. So I would assume, and I thought that the way we budgeted was we would put in what we anticipated in the way of income for that year.
We do put in what we anticipate of income, and it is the net of the two. But it has always been the structure that gross rent potential included all units that could potentially have been leased on that first day. It is something we can consider going forward for budget amendments for newly leasing buildings. But because of how gross rent potential has always been based on available units for rent, that's why you see such a large disparity in the first year.
Well, I mean, I hear you. I guess I haven't noticed it before. It probably hasn't been discussed, but it is something that I think we might look at because just the optics are
absolutely. And Commissioner
crazy.
Nelson, we actually spoke about this internally as a team as well. We were following the protocols that we've set out and how we've approached this in the past, but we are having internal discussions on how we reflect this moving forward. And so we've had this exact discussion prior to today's meeting. And so we will, of course, as we move forward with budget amendments, reflect a new approach as we consider and have an opportunity to talk through the mechanics and ensure that we're able to report accurately in terms of what the anticipated lease up would be based on that time frame.
We're on the same track.
We are.
No, and that's good to hear. I am curious though, I mean, since this is an amendment, whatever we had originally budgeted, I wasn't sure if some of this was a matter of timing. Maybe we had anticipated it to come online earlier in the original budget, so now there's a vacancy loss that we hadn't initially budgeted for, or
it's called a budget amendment, but in fact, this is the first time you are approving an operating budget for both the Leggett and the Laureate. It is a budget amendment to our calendar year portfolio because we were adding an operating budget to that portfolio, but this is the first time that you've approved an operating budget for these two properties. It's also worth noting that we've only had one new building come up since 2008 when we did Metro Point. We do have many more buildings coming forward. So looking at how we present these going forward is something that will take place.
I join my colleagues and would like to encourage us to budget realistically based on what we anticipate the fill up of the building to be, so that then when there are variances, we know whether it's an operational issue or not.
Okay. 2008 was the last building we owned.
No, we brought up the Lindley was the only building since 2008. So the Lindley and Chevy Chase was the last building that we brought up.
Okay. All right, back to, there's a motion for approval, or I lost track. Did you make the motion?
I did not make the motion, but I will make the motion.
I will entertain a motion for joining the staff's recommendation.
I move that we join the staff's recommendation to send this to the full commission for approval of the proposed budget amendment.
And is there a second?
I second.
All in favor, say aye.
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 The motion is approved.
Thank you.
We will now move on to the next item, property management contracts.
I'll get us started here, commissioners. This is a request from staff for support in extending property management contracts for a number of our properties where our current property management contracts would expire either on June 30th and or on September 30th. As you know, we've gone through a pretty extensive process of revamping our RFP to get those RFPs out, to have the amount of detail that we all agreed should be included in each of those procurements, as well as to ensure that staff has the appropriate time to review and make recommendations to the board. It's our request to do a short-term extension of the contracts. We're also incorporating ample time for a transition. So once a new contractor, or if it's the same contractor, either way, we want to make sure that there's an appropriate time to transition to the requirements that are set out in the RFP, and or transfer the institutional knowledge and the day-to-day mechanisms to whoever might be the new contractor to take over that property or property manager. And I'll turn it over to the team to provide a little bit more context related to those specifics, but that's the overall request that we're advancing.
And good morning again, Alex Thornton, Asset Manager. As Chelsea stated, we are requesting the extension of property management contracts that are expiring between June 30th of 2023 and September 30th of 2023. The staff has been working on a new solicitation for all property management contracts. However, we require additional time to publish the RFPs and allow firms ample opportunity to respond, as well as allow the staff to undertake a significant evaluation effort and prepare the material for the commission. We're proposing an extension to December 31st, 2023 for the management agreements expiring in June and July of this year, and an extension to March 1st, 2024 for the agreements expiring in September of this year. It is our goal to complete each of these solicitations and engage in new property management agreements prior to that extension date. And we're able to end current agreements with a 30-day notice if needed. We have carefully considered the proposed extension date, and we can work within these parameters to deliver on a complete RFP cycle. So just let us know if you have any questions.
Are there any questions? Then do I hear a motion to join the staff's recommendation to forward these extensions to the full commission for approval? Pardon me.
So moved.
I second.
All in favor?
Aye.
And
then the motion.
aye.
Thank you.
Thank you.
The next item is an update on the single audit corrective action plan.
Thank you, commissioners. This presentation and update will be provided by Darcel Cox. I'm hoping we can pin her. But this is a memo update that provides an overview in terms of how we have been taking the steps that we need to ensure that we adhere to our corrective action plan. You will see in the details that we've provided that we are on track, and we anticipate accomplishing all of the action items that we've identified prior to and or on time for our submittal and update to HUD in July. And I guess I'll pause to ask if there's any questions while the team also works on ensuring that Darcel is available. I know she's virtually present with us.
I have a couple of points. Pardon me, I'm sorry. I realize we're developing a plan consistent with what we said we would do. But when it comes to auditing 23, are we going to find that we have some more findings in 23 because we had not made full correction during the course?
Well, the audit actually has already started here for 23. Right. And I will say that in a proactive measure, our compliance team procured an outside company to do a full 100% audit review. We're working through to anticipate and prepare for the audit. Our expectation is that we would have addressed many of the issues and therefore looking forward to a more positive outcome this next audit. But I will say that we've had and experienced challenges along the way with trying to make sure that we can get all of our files electronically submitted by our third-party property managers so that we can have the type of QC that we'd like to have. But our anticipation is that we would, of course, corrected these issues and do not anticipate another negative audit outcome.
And is the cost of the Quadel contract come out of the excess money that we have in admin fees?
We have not, and I'll defer to our acting CFO in terms of the source that's been identified. I'm not certain if we've gone that detailed in terms of determining what the source of the 61,000 would be.
I'd have to take a look. I mean, the two major programs that are being reviewed is PBRA, project-based rental assistance, as well as HCBP. HCBP obviously has a healthy admin budget. I would expect that is where the bulk of the money is coming from, but I can certainly get back to you.
I would assume the same thing, but I'm just wondering. Okay. Any questions, Fran, or? Yeah.
I got kicked out for some reason and didn't hear a part of that, but for the last 3 sentences that I heard, I have no questions.
You didn't hear the discussion from Chelsea about the updates? Is that what you're saying?
Correct, but I'll go back and view the tape.
Right. And just to summarize, Commissioner Kelleher, I was updating the committee and indicating that we are on track to complete all of our corrective action plan items by July for our update to HUD to be timely, and that we are taking steps now and have been taking steps to try to position ourselves in the best light as we enter into yet another round of audit season.
And you also, I don't know if you heard a bit about the steps you've taken, and hopefully we won't have audit findings.
Right, and that is our hope, of course, but we are taking those proactive steps. I
don't know whether she heard.
Yes, we retained an outside company to do 100% file review. We've taken steps to train staff to enhance and increase our own QC. And so our hope is that this next round, we're not experiencing the same challenges in our upcoming audit.
Okay, is it the compliance department that oversees our compliance with these kinds of things, or who is it internally that actually is accountable for these program compliance issues?
Yes, we have Darcel Cox, our Chief Compliance Officer, who is responsible for overseeing our compliance, working with each of our different programs and with our different division leaders, doing ongoing QC training, etc. And Darcel Cox is also virtually present on the screen here as well.
Okay, thank you. We'll look forward to hearing what the consultant has to say in terms of whether any process or procedure changes are in order.
The consultant that we brought in did the file review, 100% file review is what we brought them in to do because of the challenges that we experienced in this last audit in regards to our third party property management company. In this case, it was Edgewood, related to our compliance with certain properties and files. So that was scope of work for this particular file review. Of course, we're preparing ourselves so that when we have our independent audit by CLA, that we are able to ensure that we're not still experiencing the same challenges. Because these were audit findings, we will have audit over the exact same programs for the next, I believe, 2 years.
And have we changed any of our process and procedures in order to avoid the issues that occurred in the past?
Yes, and reflected in the memo, as well as in our previous update, we outlined some of those internal operational changes that included the requirement of certain training, that included enhanced and increased QC, included us transitioning each of our companies, outsourced companies, to have to use our online portal so that we can do QC easier than having to go out to each of those sites. There's increased collaboration and ongoing internal meetings that are happening more frequently. I'm certain Darcel may be able to add any additional context. Darcel, are there any other internal modifications or changes that you believe we should also provide an update on?
Good morning. For the record, my name is Darcel Cox, Chief Compliance Officer. I really think you covered everything that we put in place, the training, the interactive process with divisions when we do quality control reviews internally. Again, the 100% file review, I'm overseeing that personally and working with Quadel on a daily basis to go through the findings or, to make sure that we get whatever we need corrected. And then also, as the executive director said, putting in an internal QC process so that we can review the files on a bi-monthly basis versus having to go out to the site once a year.
Thank you very much.
And I'm assuming that as we've gone through these changes, we've also been in consultation with the auditor so that they know what we're doing.
So we are, the audit just started and they have asked for some information as it relates to our previous set of findings. So they do have a copy of the corrective action plan, but they have not asked any questions specifically about the ongoing audit that we're doing right now.
I think specific to your question, though, yes, they are aware of what we're doing, the steps that we've taken, and we have had conversations already with them. And it's accurate what you said. We've had internal discussions as well as discussions with the auditor, and we have provided them with the first batch of information, which is through the third quarter. Once fourth quarter wraps up, we'll push out the final information to them.
Okay. Any other questions? If there are no other questions, then this concludes the meeting. No more agenda items. Thank you all for participation.
Thank you.
Thank you.
Thank you.